The current account deficit widened marginally to 3.5% in the third quarter from a revised 3.4% in the second quarter. A market analyst says this is going the wrong direction, as government's target is to keep the deficit of the current account of the balance of payments at 3%.
The financial account, which really tracks the amount of foreign capital coming into the local stock market, into the bond market, investors took out in the form of capital, interest and dividends an amount of 170 billion rand.
So why should you care about the current account deficit?
Of course, the effect of that is that the rand weakens. And with the weakening rand, the fuel price goes up, food prices go up, and generally inflation tends to trend upwards. And we know the Reserve Bank has a very strict mandate. If they feel that inflation is trending up to a level that's going to be too close or above the upper level of the target band, which is their mandate of between 3 and 6%, the closer we get to 6%, they feel they need to act, and they act by increasing interest rates. So I think it's in the interest of all South Africans, to ensure that the current account deficit is kept as close as possible to sort of less than 3%.
Naya says capital outflows are not unique to South Africa but affect other emerging markets as well. And this could be the reason why some say the Reserve Bank's MPC unexpectedly hiked interest rates last month.
With US interest rates going up, there's a shift of capital away from emerging markets, South Africa included, but also countries like Turkey, Brazil, China, Russia. Capital is moving away from these emerging markets back to the safe haven of the US.
The JSE is down 15% this year, with the share prices of the biggest 40 companies down 13% on average so far. Naya says our bond markets have not fared any better, and a downgrade from Moody's could make things difficult for government's debt repayment. It is the only ratings agency that has our debt at investment grade. Dimakatso Tugwana, Johannesburg.